Hey Michael, how are you?
Hey, Michelle. Happy Friday.
Happy Friday to you too. How are you doing? Good?
Good, good. Yeah,
Okay,
looking forward to the
great.
weekend.
So I have Michael Abram here with me with Cross Country Mortgage, expert in home mortgages, and we're going to do a little talk, and you're going to, I guess, bring us up to date with what's going on in the mortgage world, which has been kind of a up and down story lately, and everybody's
Mhm.
concerned about mortgages, and so hopefully you can bring a little bit of clarity.
Yeah.
So I think, well, we all know, I think, unless you've been sleeping under a rock, that we all know that rates have gone up lately from like the three average percent, rate to like we're in the 5% world now. And I heard that I think rates went down for a little bit and went back up. And so what's been going on? Where are we at now?
So right now we're seeing rates kind of jumping back up a little bit. We did have a lot of volatility with rates dropping, and that was simply because there was a lot of concern that we were actually in a recession. So the banks responded by dropping the rates. But now they're getting pushed back from the Fed. The Fed is not acknowledging any kind of recession. So rates are slowly ticking back up with a possible rate hike again in
In September?
the next
Yeah.
Fed meeting is in mid-September.
Yeah, that's what I heard again. And what percentage are they talking about this time?
They're talking about another three-quarter rate hike to the prime rate. So that would push prime, if that happens, to six and
6.25. Yeah. So yeah, party is over, I think.
big jump.
uh, yeah, and I know a lot of buyers who are in the market today are. I correct me if I'm wrong. I think there's two types of buyers. They're the ones who were in the market back when the rates were around 3%, and today they're really frustrated because they weren't able to take advantage of those rates back then. Whether it was because they couldn't find the right home, they were overbid, they were waiting for something, who knows? And so today they're frustrated. And then there's also another part of buyers who are entering the market today and who are not jaded by these, historical rates we had a while back. And they're like, okay, rates are, 5.5%, 6%. That's what it is. Am I right? Is that what you're encountering?
Yeah, absolutely. I mean, the only other tidbit would be that the buyers that got sidelined, it's simply because they got priced out now because they can't qualify with rates that are 2% or more higher. So it's forcing them to be sidelined because they just can't mathematically afford it.
Yeah, yeah. I think it's really interesting. I think recently you actually did an estimation of payments for a client of mine who was thinking about putting their home on the market, and we saw that based on the rates at 3% and today in the 5% range, there was like I think a 3 to 4. It was a pretty expensive house, and it was like a $3,000 difference in terms of their payments between back then and today. So it does make a huge difference for somebody putting their home on the market, and buyers, the pool of buyers that could afford their home before can't afford it anymore.
Right.
So,
It's a much smaller pool. That's
yeah.
for sure.
So for those buyers who are or who were on the sidelines, um, what are you suggesting? Is there like any creative way for you to help with financing?
Yeah, there are a lot of ways to do that. I think what I've been focusing on is a lot of hybrid interest only loans. Hybrid means it's a combination of fixed mortgage with some parts of it being interest only for the first, say, 10 years. That way, with the rates being a bit higher right now, it keeps their payments a little bit lower.
So
So
interest
it
only,
means,
just to clarify, means that this loan only requires that you pay the interest on the amount of money that you've borrowed, but no money is going towards the principal, the actual. So your principal itself doesn't go down, but at least you are able to borrow that money to purchase the property. You're just paying the interest. And correct me if I'm wrong, if you want to start paying some money against the principal, usually you're able to do that as well, right?
100% correct on all of that. And
Yeah.
where I'm focusing is on those programs that are more fixed rate loans, like a 30-year fix with the interest only, or a 40-year fix with the interest only versus an adjustable rate mortgage or a shorthand ARM, right? Where it's a teaser rate for, say, 5 years or 7 years
Mm-hmm.
only. And then after that, your payment can adjust. It'll come out of interest only, and your payments can jump a lot. You can't control that. So I think from the standpoint of keeping people a little more comfortable, doing a fixed mortgage with the interest only combination of it makes them feel more comfortable to know that their interest rate will never change. They did nothing after that interest only period's over. It's very easy to see what your payment would be if you did.
Oh, you just broke up a little bit. It's very easy to what?
It's very easy to see what their payment would be if they did nothing but pay interest only and then go into a fixed rate loan after the interest only period is over.
I see. Okay, so yeah, so that's a really smart way for somebody to be able to still buy a home today, take advantage of the prices that are maybe somewhat, if not going down, at least not going up at this point, which is another discussion about where it's going on with real estate prices. And so it's a hybrid of having a fixed rate loan where it makes them feel safe that the rates aren't going up, and then they have an adjustable rate loan that is probably lower, but allows them to combine both together and purchase the house. And then that adjustable rate is only for a certain amount of time, right? And then eventually it's going to lock into a fixed rate.
That's
right?
correct. Yeah, there's more risk on that adjustable mortgage. For the right buyer that understands these programs, that may be a good fit for them, right?
Sure.
And if it's a 5-year plan and you do a 7-year interest only, you're
Right.
going to be out before that even adjusts. So it just depends on the buyer situation to understand what we're really pitching. But the average buyer is coming in having never seen any of this
Yeah.
and just looking at interest rates and going, "Oh my God, what is happening?" So how do we
Yeah.
bring their payments down and make them comfortable and understand that now is still a good time to buy?
Yeah. Let's talk just for a minute about lenders' guidelines. Like, are they more strict, more loose? They haven't changed. We're in LA. We have a lot of self-employed people, whether they're in the entertainment industry or attorneys or doctors or people who have their own businesses. So we have a lot of self-employed people. How are the guidelines, the lenders' guidelines these days?
So they had definitely tightened up a bit after that first rate hike where it went up 0.75%. I want to say that was back in June, May or June. We saw a lot of revisions. They got a little spooked. So they made it harder, right? So
Right.
that's already challenging when you've got higher rates, and now you're making it even harder by tightening the guidelines. But since those two hikes, we have seen some of the banking programs ease up a bit. So they're increasing, say, their loan to value of how much somebody is allowed to borrow on certain programs. They may be easing back on how much they need in reserves after they close. And reserves is
Sure.
just proof of money in the bank that after you've closed, in the event that, say, you lose your job, they know you've got money to pay your mortgage. So they made that very, very expensive for a while. And now they're easing back on that as they kind of see how everything's progressing the last couple of months and how the Fed is dealing with inflation.
Okay. Well, good to know. Well, I think, as always, it's always the same thing, right? I think for all of us, it's very important for the buyers out there who want to enter the real estate world, who want to own, a piece of America, a piece of real estate. It's always really important to, prep your finances so that when you're ready to buy a home, you're actually financially ready to buy a home. And I don't just mean that you can afford it, but that your income tax returns, which is what the banks are going to look at, actually reflects that you make enough money to afford the loan. Because a lot of us who are self-employed, I think that's pretty common. We have a lot of expenses. We write off a lot of expenses, and it's great. If you want to try to limit the amount of taxes that you pay, but at the same time, it exposes you to lenders who are going to say, well, you just don't make enough money because your net income is not big enough. So as always, I think it's a good recommendation to be smart about that and prepare yourself or have a mortgage broker like you coach them on how to prepare their tax return. Well, you don't advise them on taxes, but to get them ready to have a financial image that looks good for the lenders.
Yeah, it's not uncommon for us to look at tax returns and kind of help somebody forecast what they need to show. And we always then say, go back to your CPA, run these numbers, understand what the real life effect is of you paying taxes if you file this income, right? So we can forecast like that, and they can work with both of lender and financial CPA to understand, what that's going to do. And at the end of the day, if they still don't want to do that, that's not the end of the world. There are plenty of programs that we work with on our side of the business that can do stuff that's a little more creative, right?
Hmm.
And that's the key, especially in Los Angeles and bigger metropolitan markets where you've got more self-employed, more unique industries like the entertainment industry.
Right.
And we have these programs where we can avoid tax returns and generate income a different way without showing your tax returns.
Yeah.
And that's called bank statement financing. It's literally looking at 12 months of bank statements, calculating the income, and then figuring what someone's expenses are and backing that out. So you can see someone, Michelle, that can have maybe $1,200 a month in income, but when you look at their tax returns, filing Schedule C, right? They're a 1099 employee, but they write everything off. You take that same person and take their 12 months of bank statements, and you could see they may have an income of $15,000 a month. It can be dramatically different because we're not introducing tax returns.
Right.
So, it's a very great
That's great.
alternative, and people
Yeah.
don't need to freak out, especially coming through the pandemic, where a lot of people are still impacted, where their income is still rebounding and getting back to those pre-COVID levels. And it will take 1 to 2 years of full tax returns to really show it. But in the meantime, there are programs that help them buy now without having to sit there and wait for their tax returns to catch up to that income.
Well, that's a great thing that you just mentioned, Michael. That's really great. I mean, especially like you said, for us in LA, with a lot of self-employed people, don't worry about the tax return, what it looks like. There are other options. There's a bank statement type of loan where they're just going to look at how much money you deposit on your account every month. And they're going to really be more focused on that than on how much you actually net on your tax return. That's great.
Yeah, exactly.
That's great. Yeah. Well, listen, this has been really, really informative as always, really interesting. Your information is going to be down below. So if anyone wants to get pre-approved with Michael Abram, I highly encourage you to contact him. He's an expert. He's good at what he does, and he's always available, which I really appreciate that.
My pleasure. Anytime.
All right, Michael. Well, weekend's around the corner, so have a great weekend. And thanks again for the interview, and we'll see you next time.
Sounds good, Michelle. Take care.
All right. Take care. Bye-bye.